Governor Mickey Bowman has been a member of the Board of Governors of the Federal Reserve System since 2018. She was reappointed in 2020 for a term ending on January 31st, 2034. Prior to her appointment, she served as the Kansas State Bank Commissioner, and prior to that as a vice president at Farmers and Drovers Bank in Kansas. She has held numerous other positions in government and the private sector and has been a long-standing supporter and advocate for the Community Banking Research Conference. Thank you. I'd like to thank Governor Bowman for being a champion of this conference and for actively promoting academic research on community banking. I'd ask everyone to now please join me in welcoming Governor Mickey Bowman.
Well, thank you so much, everyone. It's always a pleasure to be back in St. Louis, and especially I want to thank President Musallam and Brandon Milhorn, and of course our bank commissioners who are tirelessly willing to come back every year to discuss these important issues and to try to figure out how we move forward and what some of those solutions might look like. I want to thank also the academics and the students that spend their time focusing on these important issues, and everyone here at the St. Louis Federal Reserve, CSBS, and the FDIC for helping to focus on this conference and to ensure that it's a success every year. So it's always a pleasure and an honor for me to return to St. Louis. I don't know if many of you know that, but St. Louis is my sponsoring Reserve Bank since I had the wonderful opportunity to live in Belleville, Illinois, while my father was in the Air Force nearby. So thank you for allowing this to be my home Reserve Bank. But this conference is an effective partnership between the Federal Reserve, the CSBS, and more recently, the FDIC. It's an opportunity for us to all dig deeper into the community banking model and the important role of community banks now and, of course, into the future. Together, regulators work to ensure that the approach to supervision and regulation is fit for purpose, and that each element of both supervision and regulation acts in a complementary manner. Policy disagreements are a healthy part of that process, but we must also strive to build consensus when we can. At a minimum, we must understand and respect our counterparts' and colleagues' viewpoints. Ultimately, we all share the same goal of promoting a safe and sound banking system. The strength of the U.S. banking system relies on the diversity of its institutions and facilitating an environment that allows each category of bank to thrive is essential to fostering a healthy financial system. For community banks, this includes building a framework that better supports the unique characteristics of these institutions. Today, my remarks will consider three foundational questions as we contemplate revising the community banking framework. First, given the continued evolution of the banking system, how should a community bank be defined? Second, as we pursue the most appropriate approach to supervision, or are we pursuing the most appropriate approach to supervision and regulation of community banks? And three, how can we build a policy framework that better supports and anticipates this evolution of the banking system now and into the future? So let's start with defining a community bank. By necessity, regulators divide banks into more manageable categories. The Fed has distinct portfolios that oversee community, regional, and 4 categories of the largest banks. The Federal Reserve and the federal banking agencies further subdivide these portfolios based on additional factors. But they may also depart from this framework altogether to group banks across portfolios or based on other common features. This approach to separating supervisory portfolios can enable us to more clearly articulate the tailoring applied to specific requirements of supervision and regulation. This approach has its virtues, including allowing examiners to better organize supervisory activities and training in different portfolios to focus on issues that are the most relevant for the institutions that are being examined. When appropriately executed, it can lead to better and more risk-focused supervision. which ultimately promotes a safer and more sound banking system. But of course, there are limits to this framework. And we should continue to ask if the metrics and the thresholds established through regulation, and more often recently through supervisory policy decisions, are appropriate over time as conditions change. Locking regulatory standards into a fixed asset size threshold has its costs. Over time, these fixed thresholds fail to take into account growth attributable to both broader economic growth and inflation. They are also not reflective of any changes in a particular bank's activities or risk profile. And as a result, many firms that are stable in their growth, their business model, and risk profile end up unintentionally crossing regulatory thresholds. As they approach, and certainly once they cross over these asset size lines, they must comply with additional regulatory and supervisory requirements that were specifically designed and implemented for larger and more complex firms. While the fixed threshold approach benefits from simplicity, it is necessary to periodically revisit the policy effect of these bright line thresholds. And there are certainly cases in which banks with assets of less than $10 billion face risks that are disproportionate to its asset size, warranting greater supervisory scrutiny. For these firms, asset size may vastly understate their risk profile. Often, they don't operate like traditional community banks, relying instead on non-traditional services and engaging in more complex activities. And therefore, it may be appropriate for a community bank to be subject to additional oversight. And this is particularly relevant when a bank has unremediated, long-standing supervisory issues that require more supervisory monitoring and oversight. In these cases, a community bank supervisory approach is likely not sufficient or even appropriate. But at the same time, many banks with assets over $10 billion in assets do operate like community banks with a relationship-based, straightforward business model, yet they're not regulated or supervised as such. Over time, this mismatch in supervisory expectations around this and other asset thresholds becomes more pronounced as economic growth and inflation effectively lower them. This results in potentially overly complex supervisory constructs for banks with a limited traditional community bank risk profile. Is it appropriate to impose more restrictive requirements on firms when those heightened requirements are not a deliberate policy choice based on the level of risk? Is it appropriate to treat each bank below a regulatory threshold as a traditional community bank? Historically, regulators have been willing to push more complex requirements and expectations down to smaller banks, essentially bumping them into a higher risk category, than they are to move larger firms into a lower risk tier when that treatment may be more appropriate. One important aspect of this definitional question involves the natural evolution of banking, specifically as it relates to innovation. The pushdown of regulatory and supervisory standards often applies when a bank pursues activities that fit under the broad umbrella of innovation. Innovation can be defined expansively to include engaging in bank fintech partnerships, using or considering using digital ledger technology, or even providing traditional banking services to entities that touch the crypto asset ecosystem. Innovation can present a challenging problem, both for banks and for regulators. If the cost of adopting innovation results in a bank's inclusion in a higher compliance tier, it may be difficult to encourage greater investment in innovation for the smaller banks. Establishing appropriate regulatory thresholds does not force regulators to eliminate or purge innovation from the banking system, especially among community banks. So when considering building a framework to support community banks, the definition is the key. Which banks will be in scope? The answer lies in the bank's business model the activities, and the risk profile. Where we have established fixed dollar asset thresholds, we must commit to revisit and adjust them as needed. In my view, this is a principle that extends beyond the lines of defining community banks to all regulatory and supervisory thresholds. While there is a need for flexibility in both directions, it's apparent that over time, economic growth and inflation will result in thresholds that are inappropriately low. But I'll turn now to the supervision and regulation of community banks. Establishing a definition for community banks leaves open the fundamental question of regulatory and supervisory approach. Before turning to that discussion, we need to take stock of supervision and regulation today. What areas of the framework require our review and attention? Regulation can be a powerful and effective tool to promote safety and soundness and financial stability. The special privileges that are granted with a banking charter, including deposit insurance and access to the discount window, all come with the responsibility and the obligation to comply with the bank regulatory framework. A robust presence of community banks, especially those that are remote and rural, enables access to credit, banking, and payment services in underserved markets and communities. These banks support local economies by serving consumers and small and medium-sized businesses, building an economic foundation to drive business development and growth. But community banks, like any business, face the economic reality that accompanies running a successful business. Each must manage its costs, including personnel, funding, and regulatory compliance in light of its revenues, to achieve a reasonable return on equity. When a bank's costs increase, there is, by necessity, a need to make changes if the bank hopes to maintain profitability and ultimately its survival. This usually involves either cutting costs or raising prices on banking services. But how do the realities of operating a business inform our current approach to regulation? This question becomes acutely relevant when regulators consider imposing new or revised regulations. In my mind, regulators should always ask, what is the problem this new regulation is intended to solve? What are the costs of this approach? And what are the alternative approaches that could accomplish the same goal? Before discussing a path forward, I'd like to note a recent example that highlights this concern. The final Community Reinvestment Act, or CRA regulations, issued in 2023, established new regulatory thresholds defining small, intermediate, and large banks, with the last category, large banks, including every bank with more than $2 billion in assets. In my view, this rulemaking represented a missed opportunity to rationalize the requirements of the CRA among community banks, and it ignored the fundamental differences among banks with different balance sheets and business models. An approach that applies the same evaluation standards to a bank with $2 billion in assets as it does to a bank with $2 trillion in assets arguably represents a shortcoming in considering the fundamental differences among firms and the disproportionate costs these standards may impose on the smallest banks. So let's next discuss the hidden costs of supervision and guidance. While regulation carries with it the obligation to comply with public notice and comment procedures under the Administrative Procedure Act, regulators have far more discretion in the supervisory process and in issuing guidance that is technically non-binding, but often operates as a de facto requirement. The development and implementation of new supervisory approaches and of guidance largely escape rigorous scrutiny due to the lack of formal procedural requirements for its development. This is true even though the expectations created by guidance can be equally or more impactful to banks than can rules. For example, the examination process often produces supervisory findings overemphasizing non-core and non-financial risks, highlighting issues like IT and operational risk management, and internal controls. These issues have filtered down from examinations and findings at the very largest banks to the smallest, raising the question of appropriateness in application for smaller firms. We should work to ensure that our supervision is not distracted by non-critical issues. The prevalence of supervisory findings related to non-financial metrics is in part driven by the time it may take to remediate certain issues. However, we should scrutinize whether this trend is indicative of our supervisory focus beyond financial risk and toward non-financial risks and internal processes, and whether that shift is appropriate. We should also be aware that due to the vast diversity in business models, size, and geographic footprint among banks, we should not expect every firm to follow the same standards, and we must be careful to prevent forcing uniformity through grading on a scale or grading on a curve. This risk can be exacerbated through any type of horizontal-like reviews. Supervisory findings made during the examination process inform bank ratings, which can have follow-on effects like limiting options for mergers and acquisitions, raising the cost of liquidity, or diverting resources away from other, more important bank management activities. Guidance can also impose costs on banks that are not always obvious or quantified. The purpose of guidance is to provide clarity for banks and to reduce the implementation uncertainty and risk. To serve this purpose, guidance must be clear, it must be actionable, and it must account for the needs of the targeted firms, especially for community banks. In 2023, the federal banking agencies published supervisory guidance addressing third-party risk management, guidance that was expressly applicable to community banks. As I noted at the time this guidance was issued, it included shortcomings that were known and identified, but they were not addressed prior to its publication. And while I'm pleased that the Community Bank Implementation Guide was eventually published, this recent example demonstrates that we need to ensure any new guidance provides clarity to regulated firms on its own, or that we provide additional resources at the same time that we publish the guidance. Guidance can help clarify uncertainty about the application of legal requirements or suggest how regulators may view particular activities in the supervisory process. But when guidance is unclear or ambiguous about supervisory views and expectations, it can hinder a bank's ability to clearly understand the expectations and to meet them. Community bankers feel a strong obligation to review the voluminous body of guidance that's published by regulators, knowing that even where it does not apply to them on its face, it may be pushed down to these banks as a best practice in the future. So I want to turn now to bank mergers, acquisitions, and de novo formation. Let's start with, what does a healthy banking system look like? While we often espouse the virtues of a diverse banking system, one with many different sizes of institutions and the flexibility to shift in size over time, a healthy banking system includes opportunities for both entry and exit, from de novo bank formation through merger and acquisition activity. De novo bank formation promotes competition and greater availability of banking services. As banks consolidate or wind down operations, new banks fill gaps in the banking system. But the significant decline in the number of de novo banks, as Commissioner Clark noted earlier, it raises the concerns about whether this pipeline can continue to be effective, even while there is existing and unmet need for demand for new charters. While factors other than the regulatory climate for applications may influence bank formation, the application process itself can be a significant roadblock, one that can limit the healthy formation of new community banks. For example, the M&A process, the approval process for M&A can have a disproportionate impact on community banks because the screens that are used to evaluate competitive effects of a proposed merger often result in a finding that a rural market for the M&A application is anti-competitive. Even when these transactions are eventually approved, the mechanical approach to analyzing competitive effects, which isolates deposits as the proxy for the bundling of bank services, results in many delays for M&A transactions involving community banks or requiring additional review and analysis. Some recent policy changes at the FDIC have signaled a growing awareness of the need to better recognize a broader range of competition. But I'm concerned that fully moving to a segment-by-segment analysis of competitive effects could, in practice, result in greater opportunities for regulatory objection to transactions, rather than as a mechanism to better reflect the competitive pressures for community banks. Replacing the deposit-based threshold to analyze competition with a completely open-ended approach without standards for what products will be reviewed, what standards to apply for different products, and how to approach a transaction where the competitive impacts vary by product type, it seems to promote inconsistency in the analysis among firms and even longer delays in processing times. This is especially concerning when accompanied by changes that may result in even greater barriers to M&A regulatory approval. Fostering an environment that enables bank formation and merger transactions is vital to ensuring a future for community banking. Without viable formation and merger options for all banks, but especially for community banks, we will create a barbell in the banking system. If this continues, it will eventually result in a handful of very large banks and an ever-shrinking number of community banks, with nothing left in the middle. Over time, these trends will result in a reduction in available credit and services, an increase in the number of unbanked or underbanked communities, and economic harm. So I want to turn to talking about building a framework that will better support community banks. After acknowledging the importance of community banks and effectively defining these firms, the next step is identifying principles for how these firms should be regulated and supervised. The guiding principles are relatively straightforward. The approach must be tailored to risk. It must be transparent, and it must be consistent across similar institutions. Together, these elements can create an opportunity to construct an enduring community bank regulatory and supervisory framework into the future. This conference provides an ideal venue to facilitate conversations that can help spur the development of blue sky ideas to preserve community banking well into the future. And while it would be impossible to lay out a comprehensive blueprint for a community banking reform agenda in this speech, I see several opportunities that are promising and that are essential to inclusion in that framework. So I want to shift now to talk a little bit about the value of experience. Building this framework for the future starts with personnel, the people and policymakers making decisions over the longer term. How do we approach our responsibilities? We should highlight examples that have been successful, but also reflect on the significant work that remains to be done. Congress reserved one seat on the Federal Reserve Board for someone with demonstrated primary experience in working in or supervising community banks. While Congress did not enumerate any specific additional responsibilities for this particular seat on the board, the creation of this role itself is an implicit acknowledgement of the value that this experience can bring across the board's functions, especially regarding bank supervision and regulation. This experience of having worked as a banker or as a state regulator is uncommon within the federal regulatory agencies. For example, of the current members of the Federal Reserve Board, I am the only member with experience as a banker or as a state regulator. In my view, we should ask how someone with this experience in the banking system can best serve on the board. The experience and perspective is critical. As a former community banker and at a state charter bank, and as the state bank commissioner in Kansas, I have seen and directly experienced the practical effect of supervision and regulation from both sides of the banker's desk. With this background, one understands and appreciates the importance of a respectful and healthy partnership between state and federal regulators and the need for setting high standards and applying strong oversight to banks of all sizes, including community banks. This background also provides perspective on how over-regulation can impose disproportionate burden on a community bank, over time leading to an erosion of the viability of the community banking model. The requirement for community banking experience does not equate to advocacy on behalf of community banks. And I want to say that again. It does not equate to advocacy on behalf of community banks. Instead, this role provides much needed perspective on and calls attention to bank regulatory and supervisory matters that affect community banks. When I arrived at the board, I was designated to serve as the chair of the subcommittee on smaller regional and community banking. One of my first priorities was to make clear to our examination teams and staff the importance of their work in supervising these smallest banks. After the 2008 financial crisis, although many community banks failed, much of the supervisory attention shifted to the very largest firms. The focus on this role provided the platform and opportunity to prioritize small regional and community banking issues, which led to a number of important successes, including, and I'm going to recognize a number of people in this room for the work that they've done, the creation of the Small Bank Supervision Working Group, which focuses on the unique issues facing small banks with Reserve Bank staff from across the system. The development and implementation of tools to assist community banks in complying with CECL. As interest rates were rising, I focused supervision to develop examination guidance to assess the risks associated with a changing interest rate environment and low tangible common equity, well before the spring 2023 banking failures. We improved the frequency and content of communication with community banks. And during the COVID response, we worked together with agency partners to implement approaches that encourage banks to work with their borrowers. We suspended exam timelines and extended reporting deadlines for affected banks. During that time, our staff also developed guidance for examiners as we emerged from the COVID-19 pandemic. These accomplishments highlight how prioritizing community banking issues at the highest level can improve the outcomes and experience for smaller banks. We must have a balanced approach to supervision and regulation for community banks. This approach should prioritize the key risks facing the banking system and acknowledge the costs of regulation and supervision, and consider alternatives that may be more efficient than simply adding additional requirements and expectations for smaller banks. While I'm very proud of the accomplishments and our work together, a more formal structure for this seat's responsibilities, one that includes dedicated responsibility over supervision and regulation of community banks, and to play an active role in interagency coordination bodies like the FFIEC, would go a long way toward building and preserving an enduring framework that supports community banks into the future. But let me now turn to the importance of coordination with the states. One priority that would enhance our current approach to supervision would be to more effectively engage and coordinate with state banking regulators. But what does this coordination look like in practice? As a baseline, it should include communication during the consideration of regulatory proposals. But let's begin with the examination process. One of the concerning trends in 2023 were reports, including reports from state banking regulators, that some federal supervisory actions were excessive, considering the risk posed by some smaller institutions. Historically, these types of disagreements have been uncommon because the examination process for state-chartered banks is joint between the state and the federal counterparts at Fed and the FDIC. We share responsibility for oversight of state banks and jointly participate in examinations. So it's unsurprising that we often reach similar conclusions. When there are disagreements, supervisory divergence can also signal material changes in approach or standards, a shift that fails to accomplish the goal of effective supervisory judgment and consistency in the supervision of banks of all types. There are other opportunities to expand coordination with states, both through formal coordination bodies and when engaged in rulemaking efforts that are intended to impact state-chartered institutions. These include the FFIEC, which prescribes uniform principles, standards, and reporting forms for federal bank exams, and it makes recommendations to promote consistency in bank supervision. And the FIBIC, which promotes information sharing and enhancing incident response planning, in addition to identifying cybersecurity best practices. But coordination is only effective if we are committed to working in an open, collaborative, and balanced way with the other agencies and policymakers. There are unmet opportunities on this front. For example, the FFIEC is the venue in which regulators coordinate on examination standards and discuss and agree on reporting requirements that apply to smaller banks. With a growing divergence in state and federal exam processes, we need to ask how the FFIEC can better accomplish its goals. We also need to ask whether the other important work of the FFIEC, like establishing reporting requirements, is being conducted in an appropriate way. The opportunities for input, review, and oversight of this important work are very limited, with only the board representative on the FFIEC participating. But notwithstanding these structural impediments, I have prioritized rationalizing the call report, an effort that I revived when I joined the board in 2018. These types of overly broad requirements pose their own risks to community banks. And we should remember to focus on the unglamorous work of making sure that we're not collecting more data than is necessary and appropriate for our supervisory purposes, and that we are efficient in the collection of that data. For example, by leveraging previously collected data instead of requiring further collection of the same data. Regulators also tend to be very proprietary about the development and of regulatory and supervisory proposals. Often, policies are far along in the development process before they're published for public comment in the rulemaking process. And state banking regulators rarely provide feedback on proposals before or after they're put out for comment. While regulators tasked with implementing regulations, supervision, and guidance bear the ultimate responsibility for those policy choices, this process can greatly benefit from more interaction among federal regulators and our state bank regulatory counterparts. More extensive dialogue with state regulators can improve proposals in the formulation stage by sharing practical, real-world perspectives, including observations on the impacts of intended and unintended consequences. While it's challenging to anticipate the unintended consequences of reform, casting a wide net for views can lead to better, less disruptive, and better informed policy choices. The importance of enhancing coordination between state regulators and the Federal Reserve cannot be overstated. At a recent meeting of the board's subcommittee on smaller regional and community banking, my colleagues and I were delighted to welcome representatives of the Conference of State Bank Supervisors and 4 of their state bank commissioners as members to present at our meeting. We learned firsthand about the successes, the frustrations, the concerns, and areas for improvement in the coordination between state and federal regulators. There is simply no substitute for these direct conversations and building upon improving these important intergovernmental relationships. So I want to dig down a little bit deeper into that with to discuss the collaborative approach to reform. Historically, one of the many virtues of the Federal Reserve Board is the structural incentive to work together to achieve compromise. Governors serve extended, staggered terms intended to insulate them from political considerations. The board consists of 7 independent governors who often bring their unique voices to a range of policy matters. While instances of dissent tend to attract the most attention, the Fed has a long history and tradition of engaging in thoughtful debate, exchange of views, and reaching more durable compromises on rulemaking matters. The history of consensus on bank regulatory matters is not surprising because we work toward common goals of safety and soundness and financial stability. But consensus is a powerful tool. When there is broad policy agreement, there tends to be moderation in approach, acting as a check on wild swings of the regulatory pendulum, and providing banks and holding companies with an important degree of stability in their regulatory and supervisory expectations. While it is important for regulators to adapt to changing conditions and to evolve in the face of new and emerging risks, this incremental approach tends to produce better policy and better outcomes in the banking system. The antithesis of this policy-making approach is one that involves close guarding of information, limiting the airing of competitive views or competing views, and failing to engage in meaningful discussion and debate about policy. When contrasting these two ends of the policy-making spectrum, the virtues of consensus building are even more apparent. Regulatory reform should not be a shock to the banking system, and meaningful discussion and consensus act as a check on dramatic swings of the regulatory pendulum. Collaborative reform is more effective when we have both a widespread sharing of information, analysis, and policy perspectives, and when a wide range of views is brought to bear on important regulatory questions. One way that we can accomplish this goal is through representation of those with banking or state regulatory experience representing the Federal Reserve in bodies that are influential in the shaping of policy approaches, like the FFIEC, and by embracing a culture of freely sharing information among policymakers, both within and across the regulatory agencies. But it's also important to assess the costs and benefits of existing approaches to reform. Too often, when regulators impose requirements on banks, the temptation is to overestimate the benefits and underestimate the costs. Requiring banks to report additional data allows us to better understand the operations of banks. Limiting the fees that may be charged to consumers may result in short-run reduction in consumer costs. But in the long run, regulation carries with it many costs, ranging from the direct costs of compliance and capital to indirect costs like the reduction in product offerings or increased prices for consumers. Regulators must anticipate, assess, and balance these costs in the rulemaking process, and they must accept that at times the right policy is not to impose additional regulations, but rather to take actions to reduce the burden of existing regulatory requirements. One of the key challenges to pursuing this balancing is how to effectively complete the analysis. The incremental burden of any single regulatory reform may be challenging to measure. Its cost may seem minor when weighed against the benefits. But this approach ignores the additional cost of cumulative burdens, a concern that is particularly acute among community banks faced with an onslaught of changes. If we ignore cumulative burdens, we risk more rapid and pronounced swings in the regulatory pendulum. These swings in approach risk not only our ability to effectively supervise banks, but banks' ability to effectively manage their business. When faced with regulatory change, how does a bank management review and provide meaningful comment on voluminous, concurrent regulatory proposals that may build upon proposed but not yet finalized regulations? When new rules are adopted, how can a bank ensure that it has appropriate staffing and resources to ensure compliance? The cumulative burden of regulation is rarely acknowledged in the rulemaking process. While we assess burden with respect to discrete rule changes, there is no obligation to refresh that analysis due to changes in underlying conditions or new information about impact absent a further rule change. And the analysis of a rule focuses on incremental impact of the specific regulation, ignoring likely aggregate effect of the requirements. While the minimum legal process required under the APA should be the floor for rulemaking, in my view, that's insufficient. Likewise, while policymakers have even greater discretion in pursuing changes to supervision, we need not do so in a vacuum without opportunities for and receptiveness to feedback. We can and we should expand the lens through which we consider proposals in a way that considers the cumulative effects of regulation and supervision on banks and their ultimate customers, in a way that identifies redundancies and excessive burdens, and in a way that considers multiple alternatives and the trade-offs of different approaches. And finally, I would be remiss, and I'm sure you all are breathing a sigh of relief when I say finally, because this is a really long one. I would be remiss to discuss the future of community banks and community banking without noting one of the critical mechanisms to build a sensible framework for the future: tailoring. Again, I'm going to refer back to what Commissioner Clark said earlier. Tailoring helps us calibrate regulation and supervision to the activities and risks at every tier within our oversight framework. But it's particularly important when we think about the application of prudential tools to community banks. Tailoring our approach helps with the allocation of finite resources among both banks and regulators. It enables us to right-size the approach to regulation and supervision to the complexity of banks, acknowledging that community banks that pose manageable risks in the event of their failure and no real risk to financial stability. That they simply don't warrant the same treatment as larger, more complex, and more systemically interconnected banking institutions. While in some cases policymakers have made efforts to promote appropriate tailoring, often the end result has been lacking. Even where supervisory approaches take into account the needs of community banks, the end result requires reviewing and incorporating ever-increasing guidance into their risk management activities. This was certainly the case with regulatory guidance on third-party risk management. To be clear, tailoring is not only an efficient way to allocate resources, but the lack of tailoring poses a longer-term threat to the viability of banks. As the banking system evolves, with new opportunities and new risks, the temptation is to simply increase the body of regulatory requirements without doing the necessary work of maintenance to ensure that the set of requirements that applies to banking activities is appropriate. Often our guidance has a cumulative or compounding effect. A bank cannot go to a single source or compendium to understand supervisory expectations or requirements for any particular activity. Instead, a banker must parse through multiple regulations and guidance before understanding how regulators expect an activity to be conducted. A community banking regulatory framework that enables small banks to thrive must prioritize tailoring. So in closing, I want to thank again the St. Louis Federal Reserve Bank and President Musalem for your leadership in hosting this conference. To our participants here today, thank you for your continued commitment to community banking and conducting the important research that can inform the regulatory policy agenda. Community banks may be small, but their contributions to local communities are mighty. the importance of their role in providing credit to a broad range of customers and businesses that in their absence would have far fewer banking options cannot be overstated. There is simply no alternative or replacement for community banks and the relationship banking model. If regulators believe in a dynamic banking system, if we support financial inclusion and extending the availability of banking access, we must acknowledge the importance of community banks and ensure that our regulatory framework preserves their role into the future. To function effectively, the banking system requires the presence of banks of all sizes, larger, regional, and community banks. This diversity of our financial institutions is the greatest strength of our banking system, and it can easily be imperiled by insufficiently targeted regulation, supervision, and guidance. The discussions that we will have over the next 2 days will include steps to further preserve and enhance the future of community banking. The presentations will enhance our understanding of the dynamics and pressures that shape the banking system, identify issues and concerns that may threaten different bank business models and activities, and develop policy approaches that consider the trade-offs in our regulatory and supervisory approach. I look forward to those discussions, and I thank you for your patience and the length of my remarks today.